Hey everybody, Mike Tedeschi over at Perspective Wealth Planning with this week's market breakdown video. We're going to take a look at the major four U.S. indexes, and we are also going to take a look in at the dollar, gold, and oil. We'll also take a look at some breadth readings as well. So let's jump right into it here. First, let's talk about the S&P 500 here on a daily basis. What people have been watching here over the last week or so was, and I'm going to zoom in here on an hourly chart because it shows the picture a little bit better here, that major 2600 level here on the S&P 500. All right, this was important all the way going back to the 12th, and it has been very important here over the last 6 or 7 sessions where Thursday, Friday, Monday, and Tuesday we all ran into that zone. Bulls were unable to make that move higher, but the bears were also unable to drive it back below that 2450 level. So really what we have here over the last few sessions is that trading range, which is about 200 points between 2450 and 2630. What happens here is very, very important. If we look at this, if we were to make a break above, our next major resistance level comes back in at about 2850 on the S&P 500, and our next support level comes back in at that low at around that 2200 level. So the battleground that's taking place right here is really, really important for our next directional move. When we look at this on a daily chart, a lot of people had looked at this as a potential bull flag coming from below here like this, where we had made a big sharp move higher, and we were kind of basing in this ascending triangle pattern, and we're looking for that breakout to the upside. Wednesday's action with that gap down really negated that mindset and that view. However, again, the bears didn't break it below that level. Overnight, the S&P 500 grinded about 2% higher. However, the jobs unemployment numbers came out this morning and was well worse than expected. 6.6 million new unemployed. Couple that with last week's a little over 3 million. That's almost 10 million unemployed in 2 weeks. So just really, really bad numbers for the overall economy. This looks like there's a good potential that we will go back and test this kind of low zone here. And we need to back the chart up a little bit further on weekly and then monthly time frames to really start seeing some of the next areas of support. What I will say is the S&P 500 made that original bounce right off of that breakout from 2016. So really a good technical level to make that original bounce, trading back above the 2018 lows. So that itself is a little bit of a good picture. However, if we lose this zone, I would expect us to go back and test that 1800 level on the S&P. Now, when we look at the Dow, very similar, bounced off of the 2016 area. However, it didn't get back up above the 2018 lows, which is a big negative. The Russell, as we know, has just been exceedingly weak, well below the 2018 lows. Actually bounced off of the 2016 lows, not from the up here, which would have been where we would have seen it out of the Dow and the S&P. The Nasdaq, on the other hand, didn't come anywhere near taking out 2018's lows. In fact, it's still, when we look at this, where we're at right now, it's still about 20% above that. It had been the clear leader for quite some time and continues to be so. The next level of support on this chart is those lows, and then it would be back down in here. So really, really strong hold up here from the Nasdaq, which has been that clear leader. Now, what I want to talk about is if we take a look at all of the stocks trading on the New York Stock Exchange, that's the New York Composite Index, much, much weaker than the S&P, the Dow, and the Nasdaq. Well below the 2018 lows, that wasn't even used as a support, fell all the way back to the 2016 lows. That's where it made its bounce from. If that doesn't hold, we would be looking back towards the 2012 zone. So sum total of all of the stocks here on the New York Composite Index, much weaker than some of the major U.S. indexes. And that's why we want to take a look at everything together right here, because some things are telling us a little bit of a different story. Now, let's take a look at a couple of other areas here in this market. Let's take a look at the U.S. dollar. We're going to look at this in here on a daily basis. Again, we talked about this incredible move that we had here on the dollar over the last couple of weeks. It has really just been a big move right around that zone that we've been trading in for a year or so. It looks like there's a good potential we get back up over that 100 and head back up to that 103 zone. But again, that's the resistance from a few years back. So when we look at the US dollar itself, very messy chart, messy action here, not a lot to tell. we come in here and we actually look at gold. Gold has held up extremely well. It has been now trading in a range between 1517 and 1700 here for the last week or so. Clear big support down at 1450 and clear big resistance at that 1700 level. We're watching to see if we can get back up above 1700 or if we break below that 1570 zone. And lastly, we'll take a look at oil here. Oil is sitting at basically 20-year lows, really. 19 and some change is where we made a low here versus 17 and some change back in 2002. This is a very, very, very important level here. And in fact, as I have said many, many times, right, support is not a number, it's a zone. And really this zone of support really is about 24 to that 17 area. And that's where it's starting to potentially make a potential turnaround here. We got to pay very, very close attention to that. When we look at it on a daily chart, really need to get back up over that 24 zone. There is just so much damage here. And as everybody is sitting at home, not going to work, demand is extremely low for oil at the moment. Then you still have the Saudi and Russian price war that's going on, a lot of negative components. However, if any one of those things gets dealt with, we could see a bounce out of here for oil. So we are going to continue to pay very close attention to that. Next, I want to take a look at the emerging markets. When we back this up, we look at this on a weekly time frame. All right, we've talked about the 770 level. That is where we made our initial bounce from. This still is exceedingly weak. We back this up and we look at this on a monthly time frame here. You can see the key level that we did make our bounce from. We're trading in the middle of this range. We need to either get back up over that 930 zone if we want to continue to head higher. And if we were to break underneath of these lows, we would be looking back to those 2015 lows put in there at about that 680 zone. So a lot we're paying attention to there. Let's take a look at some sentiment. So right now, the percentage of consumers that are looking for stock and bond yields to drop is rising, right? This is very, very high, and it goes back looking at the only times it was higher, the 90 recession, back when the internet bubble burst, got close when the ruble devalued back in the late 90s. The global financial crisis was higher. Sovereign debt worries is about where we are right now. So very, very high level of concern at the moment. When we look at the historical data set for that, when sentiment gets that negative, a lot of times we end up positive in the future. However, there were a few times where these numbers looked really, really, really bad, and that was all during 2008 and 2009, and also in the dot-com bubble pop right here, where we saw very negative skewed 6-month numbers, big numbers to the downside. So when we look at this data set, well, overall, it may look positive because of how many instances that did kind of essentially mark an area where we made a bounce from, like back in here and in here. We also had some times where it was very, very negative. So basically, this is one of those, it doesn't matter until it does. And so we're going to really pay attention to this because, again, sentiment is something that is very important when we get stretched in one direction. However, as we can see from that sentiment reading, if we are in the midst of another 01, 08 kind of major correction in the overall market, then even though sentiment is extreme, it can still get more extreme and still have pain for us moving forward. Also here, when we're talking about sentiment, right, we talked about the Dumb Money, Smart Money Confidence Index. It had gotten very stretched. Unfortunately, what we're starting to see here is this kind of roll back over, and that's not good. When we see price rolling back over as well as this spread potentially widening once again, that would mean we're not quite out of the woods yet. So while it looked like we were starting to head back in the right direction here on that bounce, that ultimately may not hold. And as we looked at from the technical analysis side of things, there's reason to be very cautious and concerned right here as well. Last but not least, when we talk about our breadth reading, which we haven't looked at in a few weeks because we have just essentially just continued to fall straight down, we started to finally make the turn here when we started to have this bounce. However, If you look in right here, you can start to see it flatten with the potential for it to roll over, i.e. if we have another negative day here on Thursday, April 2nd, this probably crosses back over, which is, of course, a big concern. That is not what we want to be seeing right here. Because breadth readings have been absolutely horrendous here over the last month. We started to look like maybe we were going to turn a quarter here. If we can't hold on to this and continue to head lower, that would be an extreme negative here for stocks. So a lot to pay attention to as we move forward. And as always, thank you for checking out the video. I hope it was very useful for you guys. If you have any questions, you want to reach out to me directly, you can reach me at mtedeschi@perspectivewealthplanning.com. You can give me a call at 814-580-9881. I look forward to seeing you guys next week. Take care.